All right, so good morning, everyone. Welcome to a new week. We are Monday, May the 26th, 2025, recording this about 7:30 in the morning. Okay, as we all know, the US cash markets are closed today. The futures are open for about half a day. So good moment to sort of pull back and see what's going on. Um, I guess the first thing we have to keep in mind is that Trump over the weekend apparently had a phone call initiated by the EU, sort of head of the EU, Ursula von Leyen. And essentially, in terms of on Friday, Trump put on a threatened 50% tariff, which was going to come into effect on the 1st of June on Europe. But basically, as a result of that phone call with von der Leyen, that's now been extended out to July the 9th. So essentially, we have now, 6 or 7 weeks of negotiations. Obviously, the markets have rallied. So at this point, really, I think what we have to keep in mind is that Trump is not being taken seriously by the market in the sense that, the markets go down for 6 or 12 hours and then, there's some kind of walk back or so. So the so-called taco trade, Trump always chickens out. Anyway, but we'll leave that aside for a moment when we look at some specific markets. But I just want to look at the overall situation here. And it seems to me that what I'm seeing over the last sort of, let's say week or so in terms of press conferences and the communication coming out of people like Scott Bessent and Trump himself is that there's almost like a mantra that the deficit is no longer going to be a problem if the growth is stronger than the debt. And essentially, there's this concept that they're going to grow their way out of trouble. So what we had at the beginning of the administration, let's say in the month of February, was this idea that the deficit's too high, they need to slash costs. Elon Musk came in with the Department of Government Efficiency. They're going to slash, cut. But that's proved politically too unpalatable. It's going to be very difficult to get serious spending cuts through both houses in the Congress. And we already see the Senate, certain senators are saying, going to edit and adjust the new bill. So the point is that I'm not sure that we're going to get these huge sort of cuts to the deficit. So we assume that the deficit will continue to grow. And the only way that the Trump administration and people like Scott Bessent can justify that is to actually run the economy hot. They need the growth to be bigger and faster and to outpace the deficit. And therefore, I think where we're trying to go here in terms of administration is to, as I say, to run the economy hot and to make growth stronger than the deficit increase. So what are the implications here? The implications are that the rhetoric has changed. And the rhetoric, if you remember, like from a month or 6 weeks ago, was Trump saying things like, there has to be a detox of the economy. There has to be some short-term pain, but things will get better. We haven't heard this word detox from Scott Bessent or Trump for, quite a few weeks. And now really the mantra is sort of growth. So what does that mean? So what I've got up here on the charts here, we have the real yields, and I just want to sort of point out here, if you're looking at something like the 5 year, you can see it's at 1.65. If we look at the 10, it's up to about 2.15, and the 30, we're now up to about almost 2.8%. So the point is that the real yields are going higher, and what that seems to be telling us is that they're continuing to rise, and that's telling us that the market is not confident that the budget deficit will fall, and that the market is potentially not confident that inflation is fully defeated. So this idea that with the deficit sort of at the minimum being stable but probably rising, inflation at a minimum kind of being sticky and possibly rising as well. That neither of these two factors are under control, and basically the market's saying, well, hey, that's okay, but we want sort of higher real yields. We want a much bigger return. And what's going to be interesting is that if this number in the 30 year, which we can see is now 2.72, if that gets up to, historically up to like 2.9 or 3%, and it's possible that the next test up here, just looking on the chart here, might be about 3.23. If we get up to that level, that's going to put a huge amount of pressure on the equity market, just because real projects in the real economy in the US are going to find it difficult to be financed with a real yield, over 20 or 30 years of almost 3%. So I've got to Bit of a dry throat this morning. Okay, so that's the issue. As this real yield gets up, I think increasingly that's going to start to potentially slow down the economy, which could cause sort of equities to fall. That's something to be looking out for. Just by the way, I think if we do get up to almost this 3% level, that's going to be an interesting risk reward to maybe be going sort of call spreads on something like ZB, like the 30-year bonds. Also, just because I think with real yields at this level, it's going to be difficult for the real economy to sustain its activity. This should also cause some steepening in the curve, but keep in mind, let's have a look at a few charts now. But if we actually look at the steepening, we can see that on the 10s to the 30s, it's going to bring that up. Oop, where's that? Where are we? So let's just look at the steepening. So we've had quite a lot of steepening, uh, but it's starting to come off a little bit. But if you look at the 10s, 30s as well, we're getting up to a bit of resistance at about uh, at about the 53 basis points level here. So it wouldn't surprise me if this comes off a little bit this week. So a little bit of flattening all across the board for the 2s, 30s, 2s, 10s, and maybe the 10s, 30s. Why is that? Because we have quite a lot of auctions this week. This week we have the 2s, 5s, and 7s. So just to accommodate that, we could see the front end of the curve. We could see those yields going up a little bit on the front end of the curve. So that could push down the curve a little bit, and it could actually flatten a little bit. But if we get through this resistance on the 10s, 30s, and if I'm right that the nominal yields want to keep on going up, and therefore the real yields also go up, I think that the steepening here on the 10s, 30, it could break through. We could get up to 60, 65 basis points just once we get through these short-term auctions. Okay, so let's just look at a couple of other different yields here, just to see what's going on. So on the 2-year here, we have an effective Fed funds rate at 4.33 at the moment. That's been unchanged for the last few weeks here. We know that the Fed is probably not going to hike rates, and no time soon will they be cutting rates. So we have a Fed here which is basically on hold. So this could get up to, I think really, it's possible that the 2-year yield could head up towards these levels here, about 4.13, 4.14. But at that point, it might be, an interesting level from a risk reward to be sort of buying some call spreads and something like the ZT, just because at that point, I doubt that the 2-year yield can get up to 4.33, which is the effective Fed funds rate, because that would essentially be saying that there's not going to be any cuts at all over the next 18 or 24 months or so, which to me seems highly unlikely. And I think the market won't like that as well. So as I say, if we keep in mind that the Fed funds rate is 4.33, for sure the 2-year yields can go up a little bit on continuing strong economic data and on the fact that the Fed is not cutting anytime soon. But I think if we were to see this level, as I say, 413, 414, 415, that would be a pretty good risk reward for buying the 2-year. So something like the ZT. If we look at something like the 5-year yield, a similar kind of situation, we do have, as I say, the 5-year auctions this week. So we have a lot more supply coming into the market. So, could that force the yields up a little bit? Yeah, I think it could go, up to this 420 level or something like that. Or even 422, something like that. But again, like the 2-year, I think that would be a good buy in terms of call spreads on ZF or something like that, around about the 421, 422 mark if we were to get up there. If we look at something like just going further out the curve, the 30s, I just spoke about that. We have a real yield now of about 2.8%. But if we look here at the nominal yields, you can see here just going back, there was a key overhead resistance at about 5.17%, which you can see here. We didn't quite get there. We got to about 5.15. But so basically capped at the moment. In the last couple of trading days, we've come down to retest that down to 5%. But as you can see here, that was rejected at 5%. I think honestly, if the real economy continues to have pretty good data, if the White House makes it clear that they want to run the economy a little bit hot, and that inflation also remains sticky, and that the trade deals seem to be sort of, meandering towards some kind of compromise over the next 4 or 5, 6 weeks in terms of the tariffs. I do believe that it's definitely a possibility for the 30-year yield to retest that 516, 517 level, and possibly even probably just to sort of stop out a few people and go up to 525 or something like that. What's kind of interesting just to see historically where we are, if we look at something like, I don't know, like go to the TLT, which I'll bring up here. And I want to go back a long way here. We go back, let's say, even to the monthlies here, and just put this in perspective. So if we go all the way back to inception, which is, as you can see here, which is basically at the beginning of the millennium, 2023, you can see here that we're almost at that level. I mean, it's quite a crazy. In fact, I'm going to put that on my chart here just to see where we're at. We're almost at a point here where we are, you know, almost down at levels in the TLT around about 80, 82 or so, where it hasn't been any lower since inception, going back to, basically 2002. And so I think at that point, just from a trading perspective, if we were to get down there, so as I say, something like around about 82.50, 82, something like that, or even, even better, just to stop people out, what might happen, I might just go down there and stop people out. So something like, 81.50 or 81, something right down the bottom of this very, very long-term trade range there. That would be a pretty good level, I think, from a risk reward to buy medium-term call spreads on TLT. And then you get a target up to, maybe something like 90 or, 92, something like that over time. But I'm just thinking as well, just think of the headlines and just sort of a bit of panic there. If we got headlines saying, TLT at all-time historical lows, that's not going to be great. And, if we get down to that point there, we're going to have some very elevated nominal yields, some very elevated real yields. And for markets like, it's obviously the real economy, but specifically things like the mortgage market and housing markets, that is definitely not at all good news. So that's, I think, where we're going over the next period. And then, as I say, medium term, what could happen is that those very high real yields might actually start to have real effect in the real economy, using the word real a lot, and that would sort of potentially slow down economic activity, and then the yields could all come back in a little bit. That would be the signal there. Just looking over in Germany, we have the ECB. And again, they're expected to to cut another, one or two, three times just over the next sort of period here. So if you look at something like the 2-year yield here, you can see that that's just trading in a range here. Probably, the top of that might be something like about, up here about 190, 191 or so. You see top of that trade range, maybe 192, and then, maybe all the way down to 168. So I think we're just trading in this range at the moment, and that's just going to depend on sort of Trump news. But I think, it's going to be difficult with the ECB cutting for that, again, to get over that 192, 190 kind of level. And anything, if it gets up there in terms of yields, again, sort of medium-term call spreads on the Schatz, the German 2-year, could be pretty good. Just having a quick look at the 10-year over in Germany, we see here that the yields have come down a little bit. But again, keep in mind that we still have the infrastructure spending, we have the defense spending, we're going to have more issuance. And the thing about the German 10-year is that at the moment here, you see it's about 2.6%, as we're speaking, 2.58%. But in terms of the real yield, this is much, much, much lower than the US. Because remember, the US, you've got about 4.6% on the 10-year. Here in Germany, you've got about 2.6%. So there's 2% difference here. So the real yield in Germany is extremely low. So as an investor, that doesn't make a lot of sense. And at a certain point, it seems to me that the nominal yield on the German 10-year has to go up a little bit just to become a little more attractive. It has to start offering basically a higher real yield to sort of compete with the US. So I think combined with the spending package, probably some upward pressure coming from the US and the need, quote unquote, for the German 10-year here to go a bit higher. I do think that we can see the German 10-year yield going up to maybe 2.7 or so, definitely to test up to these levels here on the chart, and maybe even over time, if the economy stays good, up to 2.9 or even 3%. But definitely, in the short term, could get up to 2.7%, and we could have a little bit of more steepening as well in the German curve. Let's say something like the 2's 10. So let's head across to FX. And what's interesting is that overnight, we did have that tweet from Trump basically saying that, he decided to allow the Europeans a bit more time to negotiate. So in theory, that was a positive for the US dollar. And we can see the US dollar coming off its sort of lows here, but not a huge reaction here. And it still seems to me that there's quite a lot of skepticism about the US dollar from a structural point of view. This idea that sort of the administration's policy is kind of chaotic. There's no sort of consistency in their policy making, and that there is some kind of outflow of U.S. assets. I think that that story is still intact. And I think the other idea is that just thinking about the US dollar is that the US administration, if they're not going to have a huge amount of income from tariffs, if they're not going to immediately onshore all of their manufacturing, the only way really to support, to reshore or to onshore, basically to bring manufacturing activity back to the US and to sort of rejig global trade, it really is for a weaker US dollar. Now, they're probably not going to say that publicly, but I think, overall, Besant and Trump wouldn't be that unhappy if the US dollar depreciates by another, sort of 4, 5, 6, 7, 8%. And so they're not going to really push back on that. But anyway, at the moment here, we've got like a first support here at about 98 or so down there. Let's see if it gets down there. And then uh, that's our first support up there. Now, if we look at the euro, well, it's probably more interesting to look at the euro here. Let's look at a few of these. Where's the euro? So if we look at the euro here, that it's interesting. It did have that sort of flagging formation and then pushing a little bit higher. For sure, I think it can push up to like the 115s level, 115.50 or something like that. But over time, that could be in a trading range until we get more clarity. But then I do think that, if the US is okay for the US dollar to depreciate, at a certain point that could press higher than that and even get up to 117 or 118. But at the moment, just trading in that range between about 15.50 down to about 113 or so, and nothing particularly interesting going on there. If we look at the yen did show some strength and it is still looking quite strong. It looks as though the trade negotiations between the US and Japan are going to go on for quite a long time. As I said, I think last week there is an election, a general election coming up in Japan. So I think the point is here that it's going to be difficult for any political party in Japan to offer too many concessions to the Trump administration. So I do believe that in the case of Japan, a trade deal is still many weeks away. Now, will that sort of pressure the US dollar against the yen? It's possible. So at the moment, it looks like it's been in a pretty strong downtrend for the last 6, 7, 8 trading days, as we saw last night, just on the Trump tweet taking back those threatened tariffs against Europe. We have seen the US dollar sort of climb a little bit against the yen. So for sure, it could climb up a little bit. But basically, this level down here, I think it wants to retest that at some point, the 140. Let's call it the 140 level down here. And then if it gets through that, it could even head down into the 130s over time. That's something interesting. Okay, I'm going to grab a bit more tea. In terms of other stuff, if we look at the commodities here, gold, just looking this morning, let's just grab gold, look up on the spot price here. You see gold just meandering here. It was pushing higher just on that weaker US dollar. But again, there's a bit of a risk on this morning following, as I've been saying, the Trump tweet. So gold at this point, what we really need to see with gold, it needs to stay above this fib retracement here. So you see the shorter term on the chart here, this shorter term fib retracement here at about 33.20 or so. Gold has pushed higher, but on this downward trend here, it's actually facing a bit of resistance. So let's see if we can get through there. I think what could happen is that gold could just drift a little bit lower during today. Again, we've just got the futures open for another few hours, so probably a bit of sideways action at the moment. What is interesting is that if we look at something like the commodities, so GSG, for example, just a broad commodities basket, you can see here that it's still just in the middle of the trade range. It's just stuck around all these moving averages here, the 100 and the 200 moving average. You can see it's right in the middle of a multi-month, if not a multi-year kind of trade range going all the way back to 2023 here. And that to me is kind of interesting. It's kind of flat. I mean, there's quite a lot of carbon sort of energy products in this sort of index here. But just in general, this is telling me a couple of things. I mean, first of all, we had the announcement on Friday that Trump is, apparently pro-nuclear, wants to speed up, the sort of the approval of sort of power plants and whatnot. That's a sort of a medium-term project. But, maybe it's this idea that, medium-term, there's going to be more of a nuclear power mix in the US. So carbon-based sort of energy sources are going to take a little bit of a hit, at least to sentiment in the short term. It's possible. Anyway, but if you look at this commodity index here, it's also telling me that In terms of inflation pressure, inflation is still sticky, but maybe it's not going to go back to those, very high 7, 8, 9% levels, just because, as long as commodities don't rip higher, it's going to be hard for inflation to rip too much higher, which is not to say that services cannot remain sticky, at 2 and 3/4%, 3% or so. But I don't think we're going to get back to, 4, 4.5 or 5% anytime soon, just because, the commodities are pretty flat here. Okay, just finally, let's have a look at the equities. As we can see, volatility did pop on Friday, just as Trump was threatening all of these tariffs. But you can see here that the volatility has come down. And probably the curve has flattened a little bit. But if we look at the futures here, you can see that they've had a pretty nice pop on Friday, again on the Trump tweet, and now the subsequent Trump tweet. And this is looking as though this was some kind of sort of bull flag. And to be honest, probably the easiest thing from a perspective of a technical analysis here is it's above all its moving averages from the 20 out to the 200. It's the fib zones. It was supported basically at the 38%. It's now looking high. So you've got to say that probably the easiest path of travel is to test this recent high at around about 59.95. Now, could the US economy slow down at some point over the next few months? It's absolutely possible, but we have to keep in mind the fact that the real economic data continues to be strong. There are a few cracks here and there, but the labor market continues to be strong. There's no economic data of great note for the next few days. And so why wouldn't the stock market continue a little bit higher here? And for sure, can the real economy weaken? Yes, but that could take weeks, if not months. And we have to see the data. The data confirming that, and we don't. And the second thing I would say is that, as I said at the top of the video, is that it seems to me that the Trump administration and Besant, they are now sort of trying to reshift the narrative a little bit to say, well, sort of like, oh, let's not talk about the deficit and pretend it's all great, and let's focus instead on the continuing low tax rate. And potentially deregulation and kind of running the economy hot. So what we're hearing out of the mouth of Trump's cabinet is this whole idea of deregulation is coming. Besant is saying, oh, at the latter part of 2025 and 2026, everything's going to boom because of all the deregulation. The tax cuts will remain in place. And the debt ceiling will be raised. Therefore, there's no problem on government spending. So we've got a situation here where the tax cuts will remain in place. Deregulation is going to kick in at some point, and basically the government's going to keep on spending money. So at that point, you could say, well, why would the economy slow down? So we have to respect that, and if that's the case, there's no reason why the stocks can't continue to go up here. At some point, with those higher nominal yields and higher real yields, that could be the battle. Are we going to get a Liz Truss moment? Possibly, but at the moment, we don't have that, at least today. And the other thing to say as well, sorry, I'm just going to grab some more tea, is that we do have NVIDIA earnings on Wednesday after the bell. That's going to be pretty important because if NVIDIA the idea is that they've got to release a new chip, which is just one level below in terms of complexity of the Blackwell chip, so therefore can be exported globally, especially to China. So if sort of NVIDIA comes out with positivity on Wednesday afternoon and says that the sort of capital expenditure for AI data centers is going full bore and that there's huge demand for the Blackwell chip and their new generation of slightly less sophisticated chips, it could be a push up. And, basically, especially for the tech sector, we can see here that NASDAQ, like if we look at ES here, just keep that chart in mind, then we look at NASDAQ, we can see it's actually a little bit stronger. And if we look at, let's say, a ratio here, I think I've got, let's say, the SPY over QQQ. Let's have a look here. Or do I have QQQ over SPY? That's well, I've got the NASDAQ here over ES. And you can see here on the futures, so you can see here that NASDAQ divided by the ES, you can see here that NASDAQ, basically since the reversal, around about the 10th of April, whatever, has outperformed. So we see Nasdaq and the tech sector is outperforming, and that makes sense because on a global scale, a lot of these sort of companies in the Nasdaq, the big behemoths, operating on a global scale with 30-40% of their income coming globally. And so, it does make sense that they would outperform. And if we get positivity from Nivea on Wednesday afternoon, this could break out. And if you just look at this ratio here, we're kind of getting up to an interesting point. I don't want to say it's sort of like a triple top, but it's a bit of a sort of a trade range here. And you could argue that, if we keep on pushing higher, we could actually get out of this box and push a little bit higher. So that's something to keep in mind. Okay, guys, so much for the overall. As I say, we want to be keeping an eye on the 30-year nominal yield, also looking at those real yields, seeing if there's any commentary about from Besant on the real yields or the 30-year yield. Let's keep our eyes out for any kind of sort of tweets from Trump. But it does seem really at this point that his tactic is very simple. He blusters and says something very aggressive and very aggravated and very exaggerated. And then, 24 or 36 hours later, there's a phone call, a concession. In his magnanimity, he says to the other person, "Okay, we'll give you a bit more time," and the market reacts. So it's almost like every time the market is dipping at this point on a Trump tweet, the idea is just to wait 24 hours and then essentially buy the dip. That seems to be the way to do it. As I say, we have Nvidia on Wednesday. The market has a short day today. There's not a huge amount of stuff. We do have the Reserve Bank of New Zealand coming up tomorrow night. That's expected to cut. And we have the ECB later in the week. We'll talk about that. But not a huge amount of data. Just one thing I just wanted to show, just quickly looking at the FX board. The only real sort of strong trend is, as you say, the US dollar weakness is starting to pick up steam again. That's something we can keep in mind. We see that the Chinese renminbi is as being sort of the fix is being fixed relatively strong. So we can see that the US dollar is started to weaken also against the Chinese renminbi. Gold is starting to pick up a little bit of strength, but nothing like what we saw back in the middle of April and whatnot. So really the only trend at this point, nothing's really. There's some of the Scandinavian currencies are doing pretty well, so that's indicating pro-risk, pro-cyclical risk, and risk on in general. But apart from that, the euro, not a huge amount of trend. It's really the US dollar. So anyone who's short the dollar index, that looks like a good call and something to stay in at the moment. Okay, I'll leave it there, guys. I'll be back in touch during the week. We'll keep the conversation going. Thank you very much.